Hi, I'm Mark Rossano, CEO and founder of C6 Capital Holdings, here with you again on PVN Network. Today we're going to walk through some different components that's impacting both the crude oil price within the United States, the curve overall, and how is that going to be impacted over the coming months as more crude gets offloaded from the water into an actual storage tank. Then we're going to shift and focus on some of the international markets, specifically Europe and Asia, in terms of economic data and what things look like going forward. And then we'll wrap up with our favorite segment of the primary vision Frac Spread Count and some of the commentary that Powell had, just kind of touching on where things can go from a Fed perspective. So just to really dive into the US right now, so the big focus is this crude that's showing up. So it's coming from all over the world, specifically the newest one, or the Armada as it's been called, flowing from Saudi Arabia. So there's different ways to time the crude coming to the US. And the big focus has been going around the Cape of Good Hope in order to take more time. Now, the Suez Canal and some of the other canals have tried to offer rebates to incentivize people to take the shorter. But again, we wanted to slow steam. We didn't want all of this crude coming up at the same time. And you might think, well, why do you want to space it out? What's the reason? And the reason is timing. We have bottlenecks on the coast. So the US coast really can't handle a VLCC or a very large crude carrier. It has to what's called lighter, which is transfer the oil or refined product, really whatever product. But in this instance, oil, have to lighter it, which means you take it from a big boat to a smaller boat and then ferry it onto to a place where you can load it into a pipe and then onto a tank. So the big issue here is timing, which is why we have this huge backlog of oil that's sitting in both Pad 3 and, as we discussed on Wednesday, which is the Gulf Coast, and then Pad 5, which is the West Coast. You have all of these crude shipments just sitting there, slowly waiting for their time to come on shore. Now, this oil already has space allocated to it in a tank. So even though it's not really being counted in the right way in terms of recognizing what our actual storage looks like, it will over time. Now, refiners, we think, are going to operate between 65% and 70% over the coming, let's call it the next 3 to 4 weeks, just because there's still some space in the distillate tanks, which means they can convert the oil into distillate. And we've seen a gasoline demand go from a terrible number just to a bad number. Now, is it going to continue to increase? We think no. We think it'll remain relatively range bound, just because people are getting stir crazy. You've been locked in your home for how many days, and all of a sudden gasoline is $1. Let's go drive around for a little bit, but you're not going to a specific store to purchase. And that's going to be the bigger issue in terms of actually getting the economy up and running and getting things moving, which is going to come through. And some of the leading indicators that we'll talk about are both PMI and the ISM numbers. So now PMI is really gauged at 50. So 50 things are the same from the prior month. And if they're above 50, things are going to get better. If they're below 50, you start coming into a contractionary period. So 47 to 53 is kind of deemed like not much has changed. When you fall below 47, you start to come into a contractionary period and can really highlight a recession or the start to a recession. ISM is something where you're looking at it from the perspective of, well, what's going to happen? Are we going to see things get better or worse? And both of these are considered leading indicators, where GDP is really looking backwards of, well, what did we do last quarter? And then we can use ISM, PMI, and some other leading indicators to get an idea of what's going to come. So it's no shock to anyone that we've seen ISM and PMIs come in, new record lows, or at least at lows that we haven't seen since 2007, and in some levels not since 1949, and on others just setting all-time new lows. Now, these are things that are going to continue to impact, as we were talking off screen. The bigger issue is the work from home. How many people are going to stay home? How many people want to limit their time exposed to the public, which will be relatively continuous, as we've seen some different companies, specifically Apple, Google, Facebook, some big contributors to, let's just say driving in pad 5 are saying work from home. In New York, how many people want to get on a subway or the Long Island Railroad to go into the city? So you're going to have this decline that's going to be rampant over the longer term period, which is why when we're looking at the long-term distillate demand, people are going to consume differently. People are not going to look to go out and splurge, because if you're furloughed, how long will I be furloughed? If you're unemployed, how long will I be unemployed? And then think about wages. You have a lot of people who are unemployed right now, which means that the competition for a job is going to increase. So you'll accept a lower wage to work. These are key aspects that are going to impact spending, and especially, and how does that, what does that mean? Like, what happens with spending? If you don't spend, means you don't move things through the supply chain, which means you don't consume refined products, which then means refiners won't consume oil. So these are some very big things that we're going to look at to figure out where is oil going to go across the curve. So now we're going to start going through some other international components and really tie in US exports. So now from pad 3, we typically send a decent amount of distillate into, or diesel rather, into Europe. So that we've seen a lot of that slow down just because we've had competition coming from both the Middle East and Asia as shipments come over. Now, the other issue is the amount of demand within Europe. They also have their own PMIs, their own GDP issues, and then let's just kind of pick that apart, because who matters the most within the Eurozone and Europe overall? And it's really at this point Germany. Germany is really kind of the driving anchor behind the euro, and really where is the euro going to go? Where's the strength going to be? And Germany has been printing some terrible numbers that really started in Q4 of last year. So like right now we had the Eurozone, GDP down 3.8% in the first quarter, but more importantly, we had a big slowdown in the German GDP. So what do we do with that going forward? So the export data, because Germany is a very large exporting nation, continues to fall. And how are we seeing that? How are we managing it? And we look at 3 specific indices to look at freight on land in terms of trucks, on sea by boat, and then by air freight. And based on these metrics, we continue to see a drop in the amount that's being both shipped as well as flown out of Germany and other key areas. Now, the trucking remains relatively stable, and only because there's a lot of movement that has to happen. But if you've been following, there has also been an increase in ships being held at port and sailors not able to get to their homes. So about 1.2 million sailors are currently issuing a strike, and if you've heard the horns, it's them protesting the fact that they can't get off the boat. So this is inherently going to also create issues, because as you slow down things coming off the boat, then you can't reload it and get it back to where it came from. And this is where you see that long-term decline. So now the UK saw a tick up in terms of actual gasoline demand, something similar to what we had in the US, but it's still not enough. Like, you're still not seeing that normalcy. And this is going to be the overhang. A lot of people have talked about the OPEC cut, which, essentially started today. Now, there was also a massive increase in oil production in April, which has found its way onto the water. Now we've seen about 1 million barrels come out of loading, as we can see from the chart, in terms of some of the big areas that, have that loading documents that are already put out in terms of 6 weeks ahead of time. So we already know what things should be slated for in May, and there's about 1 million barrel a day decline in May. Now, that is also things that have been deferred from April, and some of those May cargoes have already been deferred into June. We've had Nigeria, which has increased and decreased different types of volumes to try to maximize. Iraq has maintained their exports, and they're trying to maximize the quality of crude. Now, the reason why I say that and how that factors into Europe is because they need to maximize what they're producing, because they also have a storage problem, and distillate still has a certain amount of operation in terms of tank space. So as you kind of flow that over, well, what are exports doing from Germany, and how do we look at that bellwether in Asia? Now, South Korea is another bellwether for exports, which continue to get hit based on just the slowdown in tech, which we've seen from commentary from Apple in terms of iPhones and other different components. Then as you shift over, we've seen India. India has increased their lockdown by 2 weeks, and by increasing it by 2 weeks, they have a little bit of caveats. They're allowing some places to open and be economic zones to try to get some normalcy back. But again, with the majority of people locked at home, you're still going to see that distillate, that gasoline demand, waver. And distillate remains the key driver. Now we go to China. China has seen their increase of imports, both from Russia, and then they've started increasing it from Oman. Now, this is also starting to pare back. So we had the teapot refiners, which are the small independents in Shandong, that went all the way up to about 73%, where the SOEs or the state-owned enterprises have fallen and been around 69 to 70%. We've seen the commentary where they want to push the teapots down to about 65%, and they want to protect the SOEs and have them operate at 70%. Now, the big issue in China is what is the OSP or the official selling price going to be coming from Saudi Arabia? Now, this is where that price war gets really interesting because we've had, Russia lose sales into Belarus, a big ally, and they've been purchasing it from Saudi Arabia. So the OSPs is going to be the discount that's going to go to the actual refiner. And the Chinese refiners have been hurting, which is why you've seen that walk back of some of these refinery throughputs. So the only way to try to protect that is OSPs. And I don't know how much damage Saudi is going to want to continue on their balance sheet given the decline in their foreign reserves. Saudi Arabia remains a big focus in terms of, what do their outflows look like? What is the stability in terms of their debt profiles? Because when we look at the OPEC plus agreement, we have to consider what are the emerging markets doing, and is this going to stick? What is going to happen as prices remain low, and where is safety? From the emerging markets perspective, we've seen about $127 billion leave their markets over the last 3 months. And you can kind of see okay, well, where's it going? It's coming into the U.S. Between Fed Chairman Powell's printing, as well as this move to safety, we've seen an inflow of dollars, into our markets, which, USO is part of that market. The question is, why did we see this rally? And this rally came from people on Robinhood accounts trying to pick the bottoms to others trying to pick the low on oil, but they don't appreciate what the USO has become. And the USO has moved further down the curve, and you're not getting the full exposure to June, but you're now exposed to June, July, and September. So you're starting to get this weird dynamic in terms of selling and buying of contracts, which has helped move the front month up, but it's not something we think is sustainable. So when we look at, what is production going to be, we have to focus on what is the primary frac spread count showing. So for this week, we came in at 55. Now, our view is that we bottom out at about 40, so we should start to see some stabilization, but 55 we got to in a very quick pace. So as we look out and we think about, okay, well, what about the Eagleford? Well, the Eagleford is now under 5. So we think that we get to about 1 to 2 spreads with the Eagleford. 0 is obviously possible, but something we don't find to be likely just given EOG's activity with an electric spread. And then the Rockies, the Rockies being the northern part of the United States, is also at 5. Now, this is something that could see more pressure to the downside, just given that there's a difficulty getting to market. So the Eagleford is, closer to the coast, but also to the inherent refiners that demand the product. So there is a certain amount of stability that we can see within the southern tier. Now, as we look out and think about, okay, well, what about USO? What about the curve? We're assuming that we bottom out on a production level, coming in at about 8.5 million barrels a day from the peak of 13.1, 13.2. This is really driven by shut-ins that we've already heard about. I would say about 3.5 to 3.7 million barrels a day have been talked about from shut-ins and from, slowdown in activity, which we've obviously seen with the primary frac spread count, at the pace it's come to in terms of 55. So when we think about, okay, well, where's the oil going to go? How are we going to have this balancing act? And this is where we think the overall curve remains elevated for where we think actual demand is, because the demand is going to remain low, and we're already near tank tops in some key areas, which is going to force shut-ins further in terms of pipelines, cutting out, prorating, and trying to trying to minimize damage and minimize flow to the overall structure and keep things flowing. So the SPR has allocated about 26 to 29 million barrels to 9 different companies in order to kind of manage that flow. And now when we look out and we think about, okay, well, is there an export market? And then you turn to, well, we signed a trade deal. We had a trade deal with China that was signed on January 15th. But the trade deal also had pandemic language. And now that we look back and we think about the virus and the spread, and we kind of see that it was already there, it was already spreading. So now we have to think of, well, what does our relationship with China look like going forward? And that's where we talk about, the 9-dash line, which is the picture right there. And when you look at that picture, you get an idea of, okay, well, China's infringing on people's sovereignty, which has been known since I think it was the lie in the Rose Garden was in 2015 with President Obama. The President Xi said that, oh no, these islands, we just want to use this for oceanography and for environmental reasons and just managing things and learning more about the area that it's in. And within 6 months, they were armored with anti-ship missiles, as well as advanced satellite and advanced imagery, which relays with the radar. So there's a lot of reasons why these are now military strongholds and why we continue to use freedom of navigation. So these are issues that have been happening for years. So the issue is going to be going forward. How does the Chinese-American relationship look on trade, on supply chain? And now that we have Europe pushing to get more clarity as to where did COVID-19 originate, how can we learn more to fight it on a go-forward level? And there's been nothing but hurdles and issues getting in and getting information from China. So as we look out and think about, okay, well, how's the trade going to look? Where is oil going to go? We believe that there's going to remain a large oversupply, which now is about between 20 and 25 million barrels a day. We were at a peak about 38, and we're at about 25 right now, just based on the recovery and some of the gasoline demand. But it's not going to normalize. We're going to stay within this weird unknown as we fight new infections, as we test the reopening of not only the US, but Europe and Asia to figure out what does normalcy look like? What does demand normalize at? So, just to kind of recap what we've talked about, we've touched a lot of different things, and we have to think of, well, where do we go from here? Powell has come out and said that he's unlimited in the amount of dollars he can pump into the market. And unless you have a 401k or a house, you're going to be impacted based on this printing as inflation is pushed into the market. We've had savings increase by about 13%, and he outright said savings is going to get hurt because of these low interest rates and this inflation, which is going to be problematic as 22 million and rising don't have jobs. So if you don't have jobs, if you don't have a certainty as to what your wages are going to be, you're going to see a fear in terms of driving, in terms of buying, which leads into the refined product demands remaining low. And this is not just a US problem. This is a global issue, which is why, the mobility of the market also pushes things to kind of manage and are about and try to make some money off of it. So we're going to see this continued flow. China's pushing more product. They've actually increased the allotment that both teapots and state-owned entities can actually export into the market due to their low domestic demand. So these intricacies we're just going to continue to focus on, continue to look at, and we'll continue to try to cover things as they happen. We have a deep dive coming out next Thursday, so please sign up. It's something that I focus on and that we try to put a lot of information and go deeper than just these videos. So if you haven't subscribed yet, please do. Thank you again for your time. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you with Primary Vision Network. I'll talk to you again soon. Thanks.